STARC Band stretch. This is Tom Aspray with the Viper Report Market Wrap video for the week ending March 27th. Those of you who are not familiar with the STARC Bands, you can look on YouTube in our account. There's some, I think, a video or two using it there. An important part, briefly developed by my late friend Manny Stoller, and uses a different way, much better in my view than RS values, to indicate when the market is overbought or oversold. So here we have a chart of the SPY in Yahoo. If you don't have a platform that allows you to do STARC Bands, Yahoo's one. So you can see that we have these bands, an upper and a lower. So when you get closer to the upper, it's a high risk area to buy. Probabilities, that the prices should, 92% of the prices should stay between these bands. So of course in April of 25 we got well below it for two weeks, and by the time we got into late April, the AD line said, okay, time to get back in. If you look back historically, you can see there have been a bunch of very oversold levels down here in April of 24, back into August of 24, back into October of 23. So you look at those bands, and we moved below them essentially for the last couple of weeks, and the carnage is getting pretty bad. Typically, even if you think this market is going a lot lower, these STARC Bands tell you that the odds of a rebound are very likely in the next couple of weeks. So we're looking for that rebound, maybe to go back to 665, which is the 20-week moving average, which is 3% above where we are. So if you look at this at the QQQs, it's important when using the STARC Bands in Yahoo and other platforms that do have them, that you adjust the symbols to Manny's specification. So for here in Yahoo, you can hit this pin here. Should be a 15-period moving average, in this case on a weekly chart. 6-period moving average. This is the 15 here is for the duration of the average true range, which is involved in the calculation, and then a multiplier of 2. So in the really extremes, you can use higher multiples, but that'll get you set up for running those successfully in Yahoo. And of course, you should expect to see, this is a weekly chart, and if you drop down to daily, you can see we get down in the daily STARC Bands or up to them quite frequently. Weekly is more of a rarity, and most of those times turn out to be very great buying opportunities as long as the AD line is positive. Of course, we always like to keep an eye on what's moving where and relatively. This chart is quite interesting. So this light green here is the Russell 2000 small cap, and you can see that it's holding up the best of the bunch. That's not saying much. Okay, so here in purple is the NYSE Composite, the broad measure of the market. So both of those, and as well as the the equal weighted S&P, the RSP, are all still above zero in this scaling. You can see that's not the case for the S&P 500 in blue, or in the QQQs in red, which are from the start, from up here they went from Invesco Trust went from up 3 to down 6. S&P up 5 roughly here, and then now down 4. So that tells you a little bit, and this is a technique, as some of you know, I used oftentimes in terms of determining which instruments, ETFs or stocks, comparing them. It's very helpful. So we look at the weekly chart here of the New York Composite. You can see that a really ugly close again. So down here around 2180, about 3% below current levels, is not far away for this week's trading. You can see that this low here, is around 20,000 even, and then we have the yearly pivot here at 20,437. So you can see 80 lines. S&P made a new high just 6 weeks ago, and as did the NYSE all. So both are below their moving averages, just marginally, and this is the stocks only, so they're both below their moving averages. I'll give you the link. This is the exposure index, average exposure to U.S. equity markets by their members, and so you can see, used to be 100%, 107 on December 25th, 97.2, January 28th, 92.8, and then it really started to rock. So, it's getting back now to 60 level. And, so it tells you that, if it's minus 200 leverage short, minus 100 fully short, 0 cash in market neutral. So we're still well above market neutral levels, but not fully invested, which would be 100%, and not leveraged long, which we have not seen in years. Looking at the daily chart, the NYSE Composite, we broke out of this range. This is the range we were looking at in late last year, and traded the breakout fairly well. Of course, a lot of our longs have been either closed out or stopped out during this decline, and you can see we're reaching chart support here, as well as this low here, 21,000. Here we have pivot levels for March and the 20-period EMA. We're looking for a rally in the next couple of weeks that should get you up, towards the 20-day moving average. If we manipulate this data a little bit, so you can put in 8 down here for an extra bar and update it. Oh, good. We get the tentative April pivot is at 22,214. So, it's right around that area. So, it's a decent bounce from here. Seems likely. AD line says not yet, because it's still quite weak. And, it's testing support here. So, first of all, it's got to get above this prior peak and then the moving average. And as I mentioned, I think last week's reports, the NYSE McClellan oscillator has formed higher lows, i.e. a bullish divergence, but it really needs a strong push to the upside to confirm that. So down below here we have the bull bear. You can see it peaked up here in early 26 and it's been declining. So we're getting down to an area around minus 20 where if this is a correction and uptrend, it should start to reverse. Down here below we have that NAM exposure index. Those of you use stock charts, it's exclamation point NAAIM, and you can see that it's it was up to over 100% here, I guess, or at 100% in December. Now it's it's bounced. It was down to 60%. So that's getting to an area. If you're looking at some of these indicators and you want to try to decide whether they're useful for you, look at during different time periods. So if we look at the a 3-year version, you can see that the in April of 25 we got bull bears minus 40. I mean, going back 30 years, it's hardly ever gotten that low. And the exposure index got down here below 40 before we bottomed out. Or if you look in November or October of 23, you also they got down here to the below 30, and the bull bear minus was about where we are right now, minus 17 or so. So you can see this pattern here. We're looking for that downtrend, to be broken. There are some negatives. Looking at the high-low, you can see we got to 219 on the NYSE new lows on Friday, so we're just breaking out above here. Obviously, that's we look for a typical surge. So far, we haven't seen anything we saw in 25, but if it's going to happen, probably this week. And we've been testing that for a while. If you look at the Nasdaq, they're often lead. So 571, right back to this high here in early February, and you know, you can see the charts looking a little weaker, you know, you know, support-wise. So, you know, once again, you know, you kind of recommend you use, you know, Fibonacci as well as chart levels. So if you look at the Fibonacci levels here, you know, you can get for the Nasdaq Composite, you know, 20,557, only 400 points where we are. So that's a likely type area for a rally. You know, that doesn't mean we won't get to the 50%. And how will we tell? We'll tell by the AD numbers as we rally. Put call data has become a bit more negative. You can see when it was over 1.2 in the index, you know, on Thursday, you know, catching this rally. We're near the lower STARC bands here, you know, and so, you know, we'd expect to see, you know, a rebound, you know, after we see another drop here. You can see last week on that little bounce, we did rally, drop below 1, and then rally back. Looking at the daily chart here, you can see that, you know, for the SPY, 20-day EMA is dropping pretty sharply. All right, so that's, you know, we could get a pretty good bounce from these levels, but usually, you know, does not suggest we're close to a confirmed low right now. Could be a week, 2 weeks out. You know, obviously the resistance here is pretty well contained. You can see the fact that the 50-day is dropping below the 100-day. That's not a good sign either. So that's, you know, 677, you know, is likely to be a brick wall. And then if we do the same thing here to look and say, well, okay, next month, you know, which starts, of course, this week, and we also get new quarterly pivot numbers, you can see that the pivot now, based on, you know, the March data so far, so it obviously can change in 2 days of trading this week, is at 651. All right, so, you know, that's sort of a level, you know, to watch for a potential rebound failure. You know, on that rebound, you can see, you know, if it were to happen on Monday, you know, it would be a divergence here. And then, of course, down below the VIX, you know, it still says volatility is increasing, as is the VXN. So that's a negative for stocks as well. Those are the main negatives that I see, you know, at this point in time. Data look at the QQQ chart also is pretty ugly. You know, pretty much breaking away to the downside here. 652. You can see this low back up here in September was 557. AD line, you know, confirmed a new downtrend. We broke this support. We said that was negative, and of course, you know, those are looking to play the inverse or you know, short side. Got a nice bounce once again, failed at that moving average, and relative performance was trying to turn around, still not yet. However, this does suggest that down the road here, we're probably going to get a bottom, but I wouldn't bank on it right away. And then if we look at the weekly chart, it does look worse. You know, we've broken the support in the weekly AD line, so the next rally will have to move sharply above its moving average to suggest that this is just a pullback within an uptrend. That's my view currently. MACDs, you know, quite a bit negative. So if you look back historically, you know, they were sort of like what they were in, you know, in March of last year, you know, and finally April they bottomed out. Looking at the watch list, quite a bit of deterioration here. You can see that, you know, based on the sector report, there's 60% are positive. That's a neutral reading, you know, and if you look back, you know, you can see that there have been some improvements. Energy still, of course, is the gangbuster, and you know, we're still half in the XOP, and even when the oil is down, it's up, so it's still looking pretty good. There are some stocks that are just coming out of short-term bottom formations that do look attractive. You can see PPG in the materials also has had a nice rebound, but still at 27%. The relative performance chart here does look better. Same for industrials. They're so oversold and they've been so smacked down. Those are a couple of the sectors I'll be looking at once we get more signs of a market bottom based on the AD line. Consumer discretionary, you know, still in a clear downtrend. consumer staples, also look pretty weak. Healthcare is trying to rebound, and we still think it will. Looking at the longer term charts, we'll probably try to put something else on that. Finally, the financials, are showing some life. You can see, the short term has moved above the longer term, and that's what we're kind of looking for. So, we're in the KBE, the bank ETF, which needs a strong close next week to, otherwise we're just too early. Technology showing some life, not communication sectors. So, obviously if you connect these two lines here, we get a break. That would not be good. Utilities still look strong. I probably look to get back in them. And real estate, not so great. I want to finish by looking at comparison, which is often quite interesting. First of all, the ETF report, now 41% are above their pivots, so that's negative. You can see, growth is solidly red. Value is still holding up, so we have XLB, XOP, of course, and not seeing anything yet, in the banks or the financials, so that's what I'll be watching for next week. Short ETFs, all green. Long ETFs and leverage long, all red. So if we look at the themes report for this week, we can see that there's some pretty ugly numbers here. Let's expand this a little bit. 30% are positive based on the quarterly pivots. Robotics 22, AI mix 0. Quantum computing 0, nuclear gauge 0, open crypto international 0, so 20.5 on strategic materials. You can see, some of these look, solid red, and if you get down to the ones that probably, even the average dispense, it's at 0. Just not many above. Infrastructure. So this is based on the 3-day. So 0% out of positive 3 days in aerospace infrastructure. Then we look back at what they were like on some of these numbers, in the middle of April of 25, when that was right after the big beautiful bill and the stocks collapsed. 22%, were positive based on the on the 3-day, and some of these back to 0% like they are now, and self-drive, energy, utilities. There was not much happening here. Retail, hotels, leisure 0, infrastructure, aerospace was doing better, and then NQ's largest gauge, pretty much all negative based on the 3-day. We did have some positive daily signals at that point. Dow was also a mess, and then if you go through the, a week, 2 weeks later here, the themes report we sent out, on May 2nd. Of course, the stock market had already bottomed, at that point based on the AD lines, and of course we saw this huge, all these were positive 3-day signals at that point. Help showing you what markets we were recommending, and at that point, if you go scroll down, quite a bit of shift. Remember, these are like 0 for both of these at that point 3 weeks earlier, and now they're back into the buy mode, 100%. Neuroscience 60, etc. So that's how we're looking at at that point. Let's see what we did down in here. Aerospace was 75, and NQ's largest was at 75 too. A big shift, and you can see some of the, at that point, 3-day buys in NVIDIA and Meta at that point. Microsoft, was already. So we will be sending out the reports with the video to subscribers. If you want a copy of the themes report, just drop us a line, themes in the subject line, and Tom at viperreport.com, and hope you find this interesting. It should be a pivotal week, and we'll probably update you as we always do on Twitter. So tune in if you want to see a current valuation And, as always, send me your questions or comments. Thank you.